But this is sort of turning things on its head. If you say, well, inflation is going to be sticky and interest rates are going to remain more elevated and the Fed's not going to deliver cuts like we expect. Oh, and by the way, the Russell's going to be up 20% year to date. You'd probably say something doesn't match.
Right, it doesn't.
So what's going on?
Well, you have a huge move in biotech right now, which is compelling the 2000 to go higher. But if you extend your time of vision, go back longer than just 6 months, you're going to see massive underperformance in the 2000 versus the S&P. I think the big message for investors now is we've had 3 years of 80% up in the S&P, and what we're doing is we're focusing on looking at asset allocations, looking at exposure to equity, because our job is to trim and move into safer assets, and that's what investors should be thinking. There will be a correction, and it's time to take a look at what the exposure is to equities.
That's what you're doing now? Are you?
We've been trimming.
You're trimming and moving into safer.
As a wealth manager, it's important. Our job is to trim and move money into safe assets.
What's safe right now? What's the safest?
Municipal
Forget
bonds.
Cash, but
long-term munis right now still yielding.
Still like that.
4.25%, 4.5% tax-free, 9% taxable equivalent. But I'm not saying sell stocks.
No.
I'm saying trim on the margin if your equity exposure is above where you're comfortable with in terms of portfolio volatility.
All right, guys, we'll leave it there. Appreciate everybody's time. Thanks for being here at Post 9. In other